Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have as my co-host today, Kyle Ryan, who is also a certified financial planner, as well as a chartered financial consultant. Kyle, thanks for joining me again.
Thanks for having me.
So we did one episode already on tax planning ideas, and it's one of the 6 areas of financial planning, and it seems to be one that is very commonly, of all the financial planning tools or techniques or strategies or areas, this is the one that affects everything.
Yeah. I mean, good thing the U.S. tax code is very simple and it doesn't have thousands and thousands of pages to go through and understand. Yeah.
Good thing. But anyway, so what we've done is we actually got questions posed by internet and through artificial intelligence, which actually half the problem of filming episodes is we don't know what to talk about. And what this did is it gave us a whole list of questions that served as an opportunity to discuss. And hopefully this is something that you might be thinking about, that you can learn something as well. So, ready to kick it off?
Let's do it.
Almost certainly this is going to take 2 more episodes. There are 13 questions, and the way you and I operate, we'll get done 2 or 3 in an episode. So we're going to do a little bit better at trying to zip through the questions a little bit faster. So the first question is, how do tax brackets affect my income taxes?
One way of answering that is saying tax brackets determine your income tax, right? Because depending on what type of income you have, not just what amount of income, what type of income you have, because not to add complexity to this, but there are different tax brackets for different types of income. If you have investment income, say you sell something for a capital gain, you've had it in a non-qualified account, you sell it after a year, that's going to be treated as a more favorable tax treatment. You make money from work, that has a whole different tax code, what most people are familiar with, the federal income tax brackets. There's state income tax brackets, there's a separate one for Social Security, so it depends on the type of income that'll determine what tax bracket you're really referring to.
So we'll stick with the regular, ordinary income, which would be your work income, interest, investment income that is not getting preferential tax treatment. And basically what happens is that the United States is in a graduated tax system. That means the first little bit gets taxed at 10%, and then from the next little bit gets taxed at 12%, and then the next little bit at 22%, then 24%, then 32%, then 35%, then 37%. As long as I've been alive, we've always been in a graduated tax system. Now, the one thing that's really important to discuss is most common misnomer that we see out there is people, oh my goodness, I just went into the new tax bracket, the world's coming to an end. Yeah. The reality of it is no. Okay, because it's a graduated tax system, the 2 biggest jumps are from 12 to 22. It's 10% or 83% relative to the prior bracket. But all it is that if you're $5,000 over that bracket, you're only paying the higher tax rate on just that $5,000.
And I remember as a kid, a quick story is like my mom, when we were born, she stopped working. We grew up a little bit. She had more time. She went back to work, and all of a sudden she goes back to work. And I remember hearing this as a kid, like, oh my gosh, this extra income, it's putting me in the next tax bracket. Why are we doing it? Why even work? We've had questions before. Should I turn down this raise? Should I turn down this promotion because it'll put me in a new tax bracket? And that goes right back to what you're saying. It's all graduated, so don't go turning away more money because you're going to have to pay a little higher tax percentage on it.
And what also happens at times too is people work overtime, and all of a sudden they're like, it's not worth working overtime because I'm paying more taxes. But the reality of it is that that's only based on that pay stub. And what happens is that at the end of the year, it washes itself out.
Yep.
I heard those all the time too.
Yep. So the more income you have, the higher percentage of tax you'll pay.
Oh, and here we go. How can I lower my taxable income in retirement?
Now that's a very loaded and a very good question. Going back to the type, I'm not going to get too far into the type of income that we're referring to here, but whenever we have conversations about tax planning, tax strategies, it's all about paying as little as you can, not this year, but over your lifetime of taxes. And if you're very simply put, how do I lower my taxable income in retirement? What are your retirement income sources? Usually, Social Security. The days of pensions are seemingly, they're more farther and fewer between than they used to be. But really what we're probably talking about is retirement income, IRAs, retirement accounts, 401ks. So the question is, how do I lower my taxable income in retirement? It's really, how do I pay the least amount of taxes over my lifetime? And it's about looking at what tax bracket you're in today versus what tax bracket you're going to be paying when you take the money out of a taxable account in retirement.
Yeah, and we've talked about this many, many times before, that it's the phantom taxation of Social Security that often causes people to actually be in a higher marginal tax bracket. And it's very different than what you see the accountants that say your effective tax rate. All they do is they say, your tax was $10,000 and you had $100,000 worth of income, your effective tax rate is 10%. We actually look at it as, what is your marginal tax rate? And that means the next $1,000 that you take out, what tax rate you paying. And surprisingly, most middle Americans are actually going to be in a higher marginal tax bracket in retirement. So how do you lower your taxable income in retirement? Then you really be looking at Roth IRAs and more tax advantage strategies that way.
Yeah, and the only other thing I'd add in there to be aware of in retirement, because you mentioned Social Security as well as Medicare. The way they charge you for your Medicare these days is dependent upon your income. And if you don't care what you call it, if there's an exchange of money between you and the government because of your income, such as Medicare and IRMA premiums, call it what you want. We call it a tax, and that's one way that, if with proper planning, you can ideally pay less in taxes over your lifetime.
Right, and that's the key words right there that you just said: proper planning.
Yes. Yeah.
So, next question. Ohu, what are the biggest tax mistakes people make? The biggest ones? Oof.
The biggest ones, I see a lot of common ones, and I see ones that have more damaging impacts. I would say the first one that I would even remotely start off with that has the highest tax bill in terms of poor planning would be when you contribute to a 401k. What I've seen people do is contribute to an after-tax 401k for decades. And with an after-tax 401k, we won't get into the complexity of it, but you could effectively have picked either a Roth or a traditional. You pick one of those. We've seen clients with a tax bill of $400,000 of just, you take all your income out, you'd have to pay $400,000 to get access to it. That otherwise could have been avoided by selecting Roth. It could have been more beneficial if they went pre-tax. The biggest one that I've seen in terms of dollars is when you're selecting your 401k and you're making your contributions, the after-tax has really led to some big tax bills down the line.
Yeah, we saw a few of them just within the last year.
Yeah.
And, unfortunately, the difference between an after-tax and a Roth is after-tax. And, we've had this discussion because we had 3 people from the same company do it. And you almost wish that someone at that company needs to be beheaded or something.
Like, you put $500,000 over the course of 20 years in your 401k, great, it grew to $2 million. The question is, do you want to pay tax on that $1.5 million or not? If the answer is no, which I'm sure it is, then you would have clicked Roth. If you wanted to pay tax on it, you clicked after tax. So that's the simple difference. And that's a major one. So just being aware of the implications behind how you're investing your money for retirement. One of the biggest ones that we've seen in a completely different facet of it is gifting a home. Right? I want to leave my son or daughter a home. I want to leave my child my home. But I want to give it to them today. So I'm just going to give it to them, right? I'm not going to make them pay for it. I'll just transfer it to them. What happens there?
Well, when they die, when the parents die, they would have gotten a step up in cost basis where the kids would have inherited the house at its full value.
Yep.
As opposed to when they're gifted the house, oftentimes they're gifted the house, the parents bought it for $50,000. Now all of a sudden it's worth $400,000. Now the kids have to pay a 15% capital gains tax on the growth of the value. Yeah. And they thought, the problem is that they thought they were doing the right thing.
Yeah,
and
because,
people don't make mistakes intentionally.
No.
So one of the other bigger mistakes that I have found, maybe not as recently because yours definitely topped the cake. And the thing is that what's a shame with the examples that we had were people thought they were doing the right thing. They thought after tax was the Roth. Little did they realize that all of their growth was going to be taxable later, and it was no different effort as opposed to clicking this button as opposed to clicking the Roth button. Yeah. Click the Roth, not the after tax. But be that as it may.
I'd add one more big one in there. It's for self-employed individuals who aren't familiar with how to save for taxes, because if you're a business owner, say you're a sole proprietor, you could be a contractor, you name it. You're getting income. normally you get a W-2 paycheck, you have taxes withheld. Don't even think about it, right? You think about it on April 15th when you file your taxes. If you're getting paid as a self-employed business owner, you don't have taxes taken out for you. How many times have we run into it where they didn't send a single tax dollar in, you get penalized for underwithholding, and then you have a huge tax bill that you weren't ready for? That could impact your business, that could impact the cash flow, how much you were investing into it, impact your own personal finances. Understanding how, and let me add one more thing as a business owner, knowing what to expense. People think, oh, that's a write-off. I'll just go out to dinner, I'll pay for it, that's a write-off. Either not knowing what's a write-off or thinking you can write off and not have to pay anything on it. A write-off isn't just, oh, I don't have to pay tax on income, anything like that. Just understanding what you can write off and what taxes you owe as a business owner are two things that we've run into where there's a lot of tax planning opportunities to be had there.
Without a doubt. And some of the other ones I find is people move in companies and they just don't know any better and they just take their 401k out as cash. So what happens there is that all of a sudden, you're right, it gets distributed to them and all of a sudden they're doing their taxes the following year and they're getting killed because of the fact that it was not only taxable, but they get whacked with a 10% penalty. Yeah. And you just see the mistakes. I wasn't even thinking about the business owners. And you're right, they're not saving enough of that money. Rule of thumb should be 30 to 40% of the revenue that you bring in, you need to sock away for taxes.
Yep. So, plenty of mistakes out there, but I'll leave it at those three.
Yeah, I know. The biggest, I wish I was thinking about that longer. Yeah. All right, next question. How does investing impact my taxes?
Now, that's an interesting one. It kind of goes back to the first question about different tax brackets. So investing can have a serious impact on your taxes. What type of account are you investing in? If you invest in a retirement account, it's a pre-tax account. How does it impact your taxes? You get a tax deduction today. Getting more into what's likely the prevalent portion of this question, how does investing in a non-qualified account or a brokerage type of account impact my taxes? Because it kind of gets into capital gain taxation, because a lot of people may or may not know this, but say you go out, you just open an individual account, you name whatever institution, you buy a stock, it doubles, and you sell it. What happens there? If you held it for less than a year, you're going to pay ordinary income tax rates. That means you just added taxable income, right? So, and you pay the same rate that you otherwise would have paid at work. So if you hold an investment for less than a year, you pay short-term capital gains rates, same as work. If you own it for more than a year and a day, then you get to pay what's called long-term capital gains rates, which again are more preferential. You'd always rather pay long-term capital gains rate than short-term capital gains rates.
Right, and so given that, assuming it's regular ordinary income that comes from bank accounts or bond dividends, things along that nature, is you want to take a look at what your tax bracket is. If you're in a high tax bracket, then it may behoove you to invest in tax-free municipal bonds. Or just know that all of the interest that you're earning is going to be taxable. And then if you're married and your income is over $250,000, well, then they like to tack on an extra 3.8% tax on top of it.
Yes,
or $200,000 if you're single. It's just, basically, you want to know what you're investing in, what the tax impact is. And, if you're going to be investing in bonds that are tax inefficient because they distribute as ordinary income, you may want to invest in bonds inside your IRA because it's going to distribute as ordinary income anyway.
Yeah. So there's always ways to be tax efficient in your investments. Also, be aware of tax opportunities in investments. If you have a loss in a non-qualified account, you're able to sell that and actually write it off of your taxes this year up to $3,000. If you sell more than $3,000 of losses in a given year, and that's what you report, you can always carry them forward. But that's a way of being on top of tax planning. You start losing money, you can sell them at a loss. Don't buy it back for at least a month. You can put it into a similar type of investment, but that's where you can really, if you're aware of the tax strategies there, you can actually, it's never fun losing money, but at least you get a tax write-off for it. It's proper planning.
That's right. So so obviously investments impact your taxes. So the next question, what are the tax benefits of contributing to a 401k or IRA? That's an easy one. I'll let you take it. All right. That's an easy one. I'll let you take it.
Yeah, right. Well, it goes back to you either can take income off of yourself today. You can deduct your income if you're going into a pre-tax type of account. And if you're taking a tax deduction today, you're going to pay it when you distribute in retirement. So it goes back to the most important question here. How does investing in a 401k, IRA, a retirement account impact my taxes? It comes from a place of what's your tax bracket today? What do you anticipate it being in retirement? If it's going to be higher in retirement, go Roth today. If it's going to be lower in retirement, go pre-tax today so you can pay your taxes then.
Perfect. All right, so that's enough for now. We're going to take a break. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we are picking up on the second segment of going through the tax planning ideas and the questions. So, moving on.
Why not? On to the next one.
All right, so next question was, and I read this during the break, and this is a good one. How do tax brackets work for freelancers and self-employed individuals? I will take that, and I am going to assume that a freelancer, they mean the same thing.
Yeah.
Okay, so a self-employed individual it can either be incorporated through an LLC, an S corporation, or they file what's called Schedule C, which is a sole proprietor. Really doesn't matter, okay, from a tax bracket perspective. So let's talk about it. So what happens with a self-employed individual versus a person who works for a company? And let's just use the same $100,000. They each make $100,000. The person who works as a W-2 employee earns $100,000. He has to pay 6.2% Social Security tax and 1.45% for Medicare for a total of 7.65. But what's different with the self-employed individual is they make $100,000. Now they get to deduct expenses. So let me go back to the W-2 individual. If they have business expenses that are not reimbursed, unfortunately, they're not currently deductible anymore. They used to be on Schedule A over 2% of your adjusted gross income, but they're not anymore. They took it away. So now what the self-employed individual does is they have that $100,000 worth of income. Now they get to deduct any business expenses. It could be travel, it could be business type of meals, cell phone usage, your computer, you have the internet at home, you need the internet, you can write that off. People working from home, and I'm going to tell you to be very careful about this, but people legitimately working from home may also write off a portion of their home as a business expense. So let me explain. If you have a 3,000 square foot house and you have an office of 300 square feet, then that office represents 10% of the size of your house, which means that you can write off 10% of your mortgage, 10% of your utility bills, et cetera, et cetera. Now, if you're writing off 10% of your mortgage, then you can only write off the other 90% on your personal tax return. But, all these are expenses. The printer paper.
Your cell phone.
The cell phone, I'd said that, but it's just a lot of different things. You can write them off. So the problem is to write it off, you have to spend the money, but you get to write it off. So if, let's say, you're able to write off $10,000 worth of expenses, now you're subject to tax on only $90,000, not the full 100. So now what happens is that all the same taxes apply to you. You have the federal income tax, but it's based on 90. You have state income tax based on 90, but the Social Security and Medicare, which is 7.65%, the problem is with the employer, you are the employee and the employer, which means you have to pay both sides, which is 15.3%. And then the other taxes come into play, local taxes, et cetera. So your tax rate is higher by 7.65% because of the second layer of Social Security and Medicare, but you're paying on a lower dollar amount. Then you also have, under the new tax rates, the tax laws, is they have what's called qualified business income deduction. And so if your profit is $90,000, you get to write off 20% of that. So now you're writing off an extra 18 grand. That is a beautiful thing.
Yeah.
So the self-employed individual has a lot of opportunity there, but as we pointed out in the first section, in the first segment, is still you need to be careful that you are saving enough money. Now the other thing to point out is you really should be making quarterly estimated payments, because if your tax at the end of the year is $10,000, you can't just decide on April 15th of the following year that you're going to give the government $10,000. They're expecting their money along the way. In fact, they're expecting at least 90% of that in there. So if you're not contributing at least 90% of this year's income, you need to be submitting that on a quarterly basis. The quarterly estimated payments are April 15th, June 15th, September 15th, and January 15th, based upon your income during those quarters. So the self-employed individual has more opportunities, but they have more work to do as far as doing their own finances.
Now, I've been asked this before, so I'll continue on the conversation by asking you this. So with the double taxation of Social Security, effectively, I've been asked, hey, does it make more sense now to take a pre-tax deduction as a business owner, because I have to pay that extra Social Security tax? My tax rates are higher than they otherwise would be. Should I take a tax deduction?
It's a great question. So the problem is with the SEP IRA is a tax deduction off of your $90,000, but it doesn't reduce the amount that is subject to the Social Security tax. Secondly is, and this is a big misnomer that I've even found with the accountants. The accountants don't catch this. Yeah. If I'm in a 24% tax bracket and I contribute $10,000 to my SEP IRA, that reduces my business profit by $10,000. And since I am getting a qualified business income deduction of 20%, I'm getting 20% on $10,000 less. So in effect, what's really happening is I am only getting a tax deduction for 80% of what my actual tax bracket is. So if I'm in a 24% marginal tax bracket, that money that I contributed to my SEP IRA, I only got a tax deduction equivalent to 80% of that 24, which is 19.2%. So if you're looking at what's my tax bracket today versus my tax bracket later, you need to take that into consideration. Now, what we have done with many folks is you can contribute to a traditional IRA, which is either $7,000 or $8,000, depending on whether or not you're over the age of 50. That does not lower your profit.
Yes.
Which means if you're in a 24% tax bracket, you're getting the full 24%.
Yep.
So thanks for bringing that up.
Yeah, of course. One thing with making a traditional IRA contribution, just be aware of the income limitations there. You can make too much money to take a deductible IRA contribution, so just be aware of that.
That would be if your spouse is working.
If one of you has access to an employer-sponsored retirement plan.
If you're an individual or your spouse does not work and you're an individual, you can make $10 million, and it has no bearing on the amount that you can contribute to a traditional IRA. As far as contributing to a SEP IRA, that's limited to 20% of your profit.
Yep.
And again, that has income limitations, which I think are either 69,000.
Yeah, 20% is some
Right.
70 number, yeah.
Right.
Yep.
So thanks for bringing it up. Okay, next question. How does selling a house affect my taxes? Now, I am going to assume that means selling your primary residence.
Yes, selling your primary residence has. This is my favorite question. Asking someone like, "Hey, how much do you think? How much in taxes do you think you're going to pay from selling your home?" Most of the time, the answer is zero. So, if you have a home and you plan on selling it, the question is, have you lived there for 2 of the last 5 years? If you have, you qualify for a capital gain exclusion on your primary residence. What that equals is $250,000 per person. So, say you own a house jointly with your spouse. You bought it many years ago for $250,000. It's appreciated all the way up to $750,000. And you go to sell it. If you have lived there for 2 of the last 5 years, you can sell that, take $500,000 off of the capital gain, and pay $0 in taxes. So that's the biggest part. If you've lived there 2 of the last 5 years, you get to write off a portion of your gains.
Now, it's also important It doesn't matter whether it's a primary residence or a rental property at the end of the day, or a vacation home. At the end of the day, it's still, it gets the capital gains treatment. The only one that gets the exclusion is your primary residence if you've lived there for at least 2 of the last 5 years. But we run into this a lot, is if you exceed your capital gain exclusion, or it's a rental property, or it's your vacation home, be very cautious about your cost basis. When I say cautious, if you paid $250,000 for that property at the Jersey Shore, let's say, but you've put in $150,000 worth of improvements over the years, instead of you paying $250,000, you put $150,000 in improvements, it's as if you paid $400,000. Then you also get to write off the costs, the closing costs of buying it. So if your closing costs were $10,000 to buy it, now it's $410,000. And if I sold it for $600,000, I got closing costs on the back end, and those closing costs, generally speaking, are going to be the transfer tax, which is either 1 or 2%, plus the realtor, which is 6%. So 7 or 8% on a $600,000 house is another $50,000. Look at all of this tax money we saved just by tracking what we've done.
Tracking, keep good documentation of it.
Thank you very much. That was the one thing I was going to say is, and I did this myself, although it didn't matter because I didn't have that big of a gain, but it's important before you sell your house or when you sell your house, if you think that you're going to be at a gain, I always recommend to people before they move, literally walk around the house inside and out to refresh your memory as to what you put into it. Now, maintenance items don't count. Okay, so I mean, if you're repairing the sidewalk or the roof or what have you, those aren't considered home improvements. But if I upgrade my kitchen, or I put a patio in the backyard, or I finish my basement, those are considered to be improvements.
Yeah, we've had one strategy where someone was, going to sell their home in PA. They were going to sell their New Jersey property, go down to Florida. They weren't really in any rush. What we had them do, you've lived 2 of the last 5 years in your PA house, go ahead and sell it. Do you mind living in New Jersey for a couple years? Go live in New Jersey, live there for 2 years, establish residency. You sell that, you get your step up, or not your step up, you get your exclusion from cost basis, then go move. So if you're going to sell the property and you don't mind living there for 2 years, that's a good way of mitigating some of the tax bill.
Well, it's actually, that happened with one of my clients.
Yeah.
You're probably right. So in this particular case, she knew she was selling both properties because she was moving away, but this was during COVID. And I said, well, look, I said, you're now working from home. I said, do you care whether you're working from home in Broomall in Pennsylvania or the Jersey Shore? She says, well, actually, if we gave me my choice, I'd rather work at the Jersey Shore. I'm like, well, then pick up and move. And it so happened that maybe a year or two later, she sold her property in Pennsylvania, got her $250,000 exclusion because she lived there for at least 2 of the last 5 years. Then when she sold her property in New Jersey, on top of it, there were more breaks. So not only did she get the $250,000 exclusion, but if you're a resident of New Jersey, you're exempt from certain taxes associated with selling the property. Turns out she saved $66,000.
She was happy?
She was happy. Yes, she was. She was very happy. All right, how do Roth conversions help reduce my taxes in retirement? I tell you what, Kyle, we're going to have to save this for the next episode because I just looked at the clock. We're out of time. So stay tuned. We're going to come back in another episode and follow up with more questions. So thank you for joining us. I hope you understood and learned something from today. And we'll be back with you the next time. You have a wonderful day.